We are going to get started with Lane, who is an associate with us. He's an analyst with us. He wears many hats, and he's going to help us guide a quick fireside chat related to a little industry rumbling that's been happening. We then have a self-directed IRA, Kelsey, who's going to go through how, why, and what is going on with self-directed for your retirement account. And then we got Steve Long, our keynote speaker from Berkadia, who's going to share some great information with you. And then we're going to all get down to Oak Creek for a tour. It's a construction zone today. It will be for the next couple of months as we continue to finalize Oak Creek. Super excited to share that project with you. So thank you all for being here. Lane, take it away.
All right. Thank you, Scott. Thank you all for being here again today. I had a really good joke about something to do with eating, or with eating right after this presentation, but that kind of got screwed up. But no, thank you all for being here. Quick intro, my name's Lane Guger. I work on our development and acquisition team here at F Street. I come from UW-Madison. I would say go Badgers, but they have been extremely embarrassing as of late, and we get to go play Ohio State this weekend, so that'll be fun. Scott doesn't need an introduction, but one thing I will say about Scott is he is always in the know about everything that's going on. I think that's one of the things that makes him really good at what he does. It's probably an indictment on myself, but I get most of my news from Scott. He'll show up in the morning and say, hey, did you hear Trump said this? Or did you see what new crypto is on Robinhood today? So I hear most of what's going on from Scott, and that makes him perfect to talk about what we're going to discuss today, which is what happened to CrowdStreet. And am I echoing back there? Is it too bad? Should I hold it away a little bit? Good, okay. This is a conversation, as have some of the other chats been, so please feel free to shout out or raise your hand if you have any questions or comments, and we'll get going here. So many of you are involved in commercial real estate already or are considering being involved in commercial real estate, so you may have heard of CrowdStreet. But if you haven't, a little background on them. They were founded in 2014. They were essentially a platform between syndicators or sponsors like F Street, like ourselves, and accredited investors. Before platforms like this were available, it was really tough to get access to some of these institutional investments, right? So it was only held for the REITs, the hedge funds, the institutional guys, the family offices. This was one of the first things that allowed common folks like us to invest in these larger institutional deals. So in theory, all of this is great. But as we'll discuss today, they hit some bumps in the road. They had some deals go south. They had some legal battles, ultimately things that led to a lack of investor trust and some lawsuits. So before we get into all that, let's talk about the origin. So Scott, can you give some context on what made CrowdStreet so appealing at its peak and why investors flocked to its platform?
Sure. So the internet has been good for many of us and has created some platforms for vulnerability for others. And if you look at what CrowdStreet created, which was the first I would say mainstream of its type online investment platform where anybody, most people under the 506C, which is general solicitation at the time, you can go and basically invest in deals. And so there's been multiple duplications of CrowdStreet, which is Yield Street and Realty Moguls, and there's a series of other entities that now have or previously were engaged in what is making offerings of investment through their platform, where they would either be a broker-dealer or they would be a solicitor to help earn some form of advisory fee to get people to invest in their platform. The reason it gained its popularity is it was easy, right? You could do it in your pajamas. You could do it from your couch. You could be an investor in many syndicated deals throughout the country simply with the click of a button. Their accreditation process lasted for 5 years. So once you were accredited, you were basically on the platform. You were able to click buttons, and all of a sudden, $50,000, $100,000, $200,000 was sucked out of your account, and you were an investor. And they made it incredibly easy to do investing in alternatives. And so we believe that ease is what really moved a lot of people to it. It was also the new kid in town, right? It was the new guy on the block that you could go and make that investment to. And so people would click the button and become an investor. And then at dinner that night, they would tell their friends that they just invested in a deal in Austin, Texas, or wherever they ended up investing.
So you mentioned the access and the ease of access that attracted the investors. Do you think that was part of the key points that led to the downfall of CrowdStreet, and what else attributed to that?
I think it's the point, right? Ease happened, so fraud, so greed happened, and then greed yielded, unfortunately, what is an evaporation of equity, investor dollars. And so, you can't have, first of all, how many people look at OMs every day? Or offerings, right? We all kind of look at them a lot. Have you ever seen one that doesn't look good? They all look good, right? They all have, whether it's a venture deal, whether it's a real estate deal, whether it's a food and beverage deal, none of them come in and tell you how bad their product is, right? They all tell you that the market's $27 billion, they're going to take this from $0 to $24 billion, and you should invest today because you're on the cutting edge of what's going to be tomorrow. And unfortunately, not all of those deals work, right? In our real estate space, it's kind of the same thing. There is no distinction or requirement to get in to be a real estate developer. There is no requirement to be a developer. There's no requirement to be a syndicator. There's no requirement to do many of these things, right? We don't need licenses to be developers. We can syndicate transactions by filing a Form D with the SEC under the 506C. We can do all of that without any regulatory issues. So the pool, the bucket, the cesspool, if you want to call it, is massive, right? It's just a massive opportunity for people to get in. And if you take that and you take the opportunity for it to be a click of a button to enter into that pool, unfortunately, greed will overtake the opportunities. And that is, I think, the singular downfall of what happened is every deal on the platform, whether it was reviewed or not reviewed, or it was visited as investable or not, was one of those deals, was a deal that was put on there that didn't have the merits to qualify for your investment.
So you mentioned the cesspool and it being treated kind of as the Wild West prior to the regulations. So the way you look at it, and it's a nuanced question, but is that more on the sponsor? Classic example is Nightingale, who, if you haven't heard of them, they had deals in Atlanta and Miami that they took tens of millions of dollars from investors through CrowdStreet and essentially put them in their personal accounts, misappropriated them into other business accounts, classic fraud. They got caught. Ellie Schwartz, who was leading them, I think just got sentenced to 7 or 8 years in prison. So is that the responsibility of CrowdStreet, who could be seen as acting as a broker-dealer, or do you think that falls more onto the sponsor or the investor for not being responsible enough in doing their diligence?
Did I welcome everyone to our summit? I say that because CrowdStreet never had a summit. They never had any transparency, and they didn't need to because all of their voids or all of the opportunities were filled in rapid pace. So Nightingale probably didn't start out as a nefarious or a bad operator. But when a deal starts sliding, or when overhead starts to get egotistical, right? You have all of a sudden 1 employee, 10 employees, 300 employees, and payroll has to be made tomorrow. Desperate people do desperate things. And unfortunately, my guess, if you break down the Nightingale story into its lowest common denominator, was unintentional yet malicious and criminal activity that caused the pain of hundreds in terms of dollars and people. And so I think as I look through these stories, the reason I say it is I think it's really important that people visit our office. I think it's important that we create transparency. This isn't about F Street. Invest with whoever you choose to, right? You guys, I know, invest with other people. We don't ever talk about other people. We talk about us. But I encourage you to look at the cloth, look at the background, look at the history, look at the criminal activity, look at the litigious activity, look at who you're investing with, and ask the tough questions. Can you go to their office? Can you come to their summit? Can you have lunch with them? Do they answer your phone? Do they respond to you? All of that's important. I can promise you Nightingale did not call you back. I can promise you Nightingale, once they had your money, could care less about you. I say that not to be deceitful to them, or I don't know them, but to be judgmental. But the reality is, people invest with people. That breach of confidence got shielded by this interface called CrowdStreet. So you didn't have a chance to talk to Nightingale. You had a chance to listen to their webinar. You didn't get a chance to go to their office. You didn't get a chance to see what they were doing. But Nightingale was engaging in me first investing, which is really dangerous. Because if it's not investor focused first investing, nobody will come out of that. And we see a lot of that happen in the space that we're in right now, where people are not asking the tough questions. They're investing under novelties or other blinders that ultimately will come to pay the price. And I know, even having a University of Wisconsin-Madison grad as one of our analysts, I know that he can make a pro forma look perfect every single time, but it doesn't make it investable. And so we know reality. And so how do you check reality? So let's ask those tough questions, and I'm sorry if I'm jumping ahead, but let's ask those tough questions. So how do I project rent, right? What is the key factors in our projections of rent? We do what they call a market study. So we go to a company called Tracy Cross. Tracy Cross is a nationally recognized market study organization that comes into West Dallas, Wisconsin. They interview and meet and go to the competitors. They evaluate what we're doing, and they give us a report that tells us what we can achieve for rent in this market. I'll share that report with you. You can have it. We have no problem sharing the transparency of it. They also tell you what type of units to create. Should we have 80% one bedrooms and 20% two bedrooms, or vice versa? Is it a unit that will or will not work based on 3 bedrooms for demographics of families or not? It has all of these studies in it for us. And then we take those and we put them into a pro forma that equates to what we believe achievable, and then sensitivity analysis downward to determine where we could get ourselves into a problem. I can promise you Nightingale is at least 30 to 50% off on the projections of rent, or any of these folks that are missing their pro forma numbers based on a market study, if one was even done. So asking the question of how do you get to rents is subjective, right? I can get to rents on a pro forma by telling you what I have to achieve in revenue, right? But who are we kidding? Well, first you, and then ultimately me at the end of the day, because that project will not work. It does not. It can get financeable because I can get it past most banks. Nightingale's proving that. They can get it past most banks. They can get it past most investors because most investors haven't heard of what a market study is, and they don't know what the market study's purpose is, so they don't even know to ask for it. And we issue out of our investor network market studies under 10% of the time because most people don't know to ask for them. But we encourage you to, so you can see what's there. But we use that market study to determine our rents, to pro forma where we need to be, to understand our top line revenue. That to me is important. It also goes into absorption. How fast will it take you to lease up a project? So if we're projecting 12 months and it takes us 24 months and you're burning $300,000 a month of interest while you're trying to get to that number, that sounds like $3.6 million of misappropriated dollars or not educated dollars, which simply comes out of one person's pocket, an aggregate group. The investor. Your money's at risk first, right? We're the equity, you're the equity. You're the ones coming into these deals as the equity. The bank, who's at 60 or 50%, is most likely covered. So how does that harm us is what happens in these scenarios where the tough questions aren't answered with the right jockeys in place to ask the tough questions, to be able to get the answers to make your decision impactful.
I forgot what question I asked, but that was a great answer, and I think you covered most of what I
Yes,
was going to
sir.
ask.
Hold on, we got a question.
Yeah.
In light of what you all just shared with us, as F Street grows or headcount increases, the harder it becomes to keep your eye on the ball. Can you share with us a little bit about some of the internal controls that you've set up? You know, you mentioned segregated funds as an example. Do you use an accounting firm to do any audited financials, or what about on the internal side of F Street? Can you talk a little bit about that?
Yeah, of course, sure. Great question. So to back up to the beginning of your question, which is, as you grow, how do you not force a deal to happen is essentially the question.
I'm talking about the internal operations of S Street itself and the people that you have. You know, if you get a bad actor, you know, what do you have in place to prevent somebody taking you down?
Sure. Yeah, so the answer about bad actors is, you know, we're not an institution. We're a family-run small development company. The litmus test ultimately stops with me, stops with Josh, stops with Nick. We're not here. The worst thing I can do is be at a summit and tell you about our lease opportunity where we lost all your equity, right? And so that would be, in my opinion, remove us from being investable in the future. We might as well come up with a different career at that point. Yet, it's still happening today. There are deals that are being underwritten and being financed by opportunities that will never pan out, by operators that have tons of deals in the pipeline and tons of deals under construction and in lease up that will ultimately not prevail. And so we are not a quantity shop, we're a quality shop. We only do business under certain parameters, which includes in multifamily, for example, TIF financing. We only there is no way to build a multifamily project today with the costs of construction without having a TIF in place. When they tell you there is, I'd like to know what elevated number of rent are they above a market study to tell you that that's what they can get, because that happens.
So you're talking in the context of investments.
Yep.
I'm talking in the context of F Street and internal controls. And
You're talking like banking controls?
whatever, yeah.
Sure.
Yeah, and you know,
Yeah, so
third-party verification, whatever.
okay. I apologize for my initial rant, although
That's okay.
had some value. The answer you're asking is, so we use best practices at this point. We have obviously multiple authorizations to send wires and ACHs. We have passwords that are through, you know, rotate every 10 seconds, and sometimes I can't enter them fast enough to get into the system. And we use our best practices right now to get there. For our audits, for our files, our loans that are with the federal government require audits. Our single purpose entity deals are relatively straightforward, right? If you take an industrial deal, most of the time it's a single check in or 3 or 4 checks in with a single check out to pay the mortgage. They're very transparent and easy to articulate. We don't get into, unless we're forced to, auditing of those transactions, because it just adds $12,000 to $17,000 of cost that takes out of your pocket. We do have some investors that like that. We do have some RIAs that will only invest in that. And sometimes you have to balance, is it good or bad for the equity players? But we have very good means in place. The biggest risk, to be honest with you, is outside of F Street. The amount of fraud that happens in the banking industry every single day is unbelievable, and washing checks. And so we use positive pay, which is also another means to verify a check has to go through, otherwise it doesn't happen. And ACH, we're I would say on the top end or upper echelon of following all of the best practices to make sure our banking is tight.
I'd like to piggyback.
Yes, sir.
And take it a little bit deeper. In my mind, the worst thing that could possibly happen is you just walk with everything. So let's say 3 years from now, you decide to walk. What happens to our money?
Yeah, so I've had that question asked to me a couple different ways. Me walking, going to some other non-extradition country, and then getting hit by a bus. I've heard those 3 different things. The bus kind of hurt the most because I thought that would impact me a little bit more than... What?
It's a plane not landing.
Yeah, plane not landing, something like that, yeah. You know, I go back to the core tenets of who we are as people. You have to make those decisions of who you're investing with. Trust at the end of the day. There's, you know, at the ultimate end of the day, we've all read, right? Merrill Lynch advisor steals money from client and does this. This person does this. I mean, there are bad actors that are in our federal and state and courts every day, that are in prisons every day. It happens. I wish we were better people, but some people have this propensity for greed that you just can't, I do watch American Greed at night every once in a while. It's fascinating to me. But at the end of the day, it's cloth of character. It's cloth of you know, who people want to invest with. People want to invest with us. I don't have a protective method to give you a surety that I'm not on the next plane to Colombia or wherever I'm going. But I can tell you, if I probably was going to do it, it would have happened probably 5 years ago, just because I wouldn't want the other 5 years of stress. So I don't know. I think at the end of the day, we're here. We put on forums and summits and events and dinners and are transparent and open because you do invest your hard-earned money with us. I do know how hard it is to earn money and ultimately save it in 2025. I know that the cost of living and the cycles of life, and I have 2 kids in college. It's not cheap. I understand the way the world is going, and I don't think that price increase in the house that happened during COVID because of the lumber, now that the lumber's back down, is coming back down. I think it's going back up. I think we're in a perpetual cycle we're in an inflationary world that probably is going to continue. And so it's a tough question to answer. It's a real question that's on the minds of yourself and everyone else in this room. When I meet somebody on Facebook and the next day they send me a wire for $1 million, I scratch my head. I genuinely do. I said, I don't know if we've had enough time for your trust to give me $1 million via a Fed wire, and we just met on Facebook. And it happens every day. Every day we meet somebody on social media who invests with us. Think about that. So it's an amazing, I take it with the utmost level of respect and determination that I have a flawless track record. I wouldn't be here today if I couldn't continue to do what we do. We've got unbelievable widgets. Our product is well received in the market. Our disciplines are unbelievable. Our core tenets are investor-focused tenets. That's it. And so long as I have that, I feel great raising money, taking the money, and meeting you on Facebook. Know that you're trusting of me. There's something that gave you that trust. I don't know what it is, but I know it can be taken away in 1 second. It can be taken away that on the last business day of every month, when I promise you that your money will be in your ACH account, if it's a minute late, I lost your trust. And it's never happened, because it won't happen. Because I know that it is so important to the trusting of our partners. I have to do exactly what I say I'm going to do. If I breach that for a minute, you start scratching your head. You start saying that is an issue, and it has never happened.
And us as accredited investors, we just have to understand that you can lose everything, and that's why.
We tell you there's no guarantee and your money's at risk. And I tell you that expect from me 1/12 of 10% on the last business day of every month. We're going to take one more question. Anyone from here, or we're going to let Lane close up with his final question? All right, Lane.
All right, last question. You talked about it a little bit, but if you were advising one investor today who wasn't sure if they wanted to invest with F Street or if they wanted to invest with whoever else, what 3 questions would you have them ask the sponsor before they clicked invest?
Sure. I'd first call them, see if you can get to them or visit their office. I certainly think it's important to do that. I would certainly call the referrals. We provide referral references to everybody before you invest with us. We give you their name, their phone number. These are investors And you should call and ask them their experiences with us. Because if their experiences are alike, then you can expect those experiences that we're conveying. And we always do that, and we always encourage people to do that. So please call references. And then be aware of crazy returns that are out there that never will exist. When you start to see 30 plus IRRs, you should scratch your head.
Check the exit cap rate.
Yes, you
Because
should
that's what
start
they'll
looking at the entire transaction to try to figure out exactly how they can get there. Because I can deliver for you in our West Dallas apartment a 38% IRR. I can do that too. I'm gonna come up about 18% short. But I can articulate that for you to get you to consider making an investment. And I only say that because I want to protect our investors. I know you invest with me and others, us and others. The others, I just say to you, whoever they are, I hope they have the same tenets that we have as it relates to being investor focused and to value how hard it is to earn the dollars you're investing with us. So, thank you. We're going to pivot, and Mitch is going to come up here and do a quick introduction for one of the, I think, fastest growing segments of our business and one of the fastest segments growing in the investment community. That's so great, and it really is a differentiator for your retirement. And Mitch, take it away.
Thank you.